the most important question, maybe important beyond economics too, but we have a very strange attitude on that. I mean, most managements feel that on the price of their shares that the higher the better. And that's an understandable feeling. But the trouble is the game isn't over at any time. We really feel the fairer the better. Our goal is that every shareholder participates in the progress that Berkshire makes as a business during their holding period. In other words, we don't want one party getting wealthy off the other. We want them to share based on the gain in value of the business. And to the extent that the stock got way overvalued or way undervalued, that may make one party, in the first case the seller, in the second case the buyer, very happy, but there's somebody on the other side of the transaction. In economics, the most important question, maybe important beyond economics too, but when somebody tells you something, the first question to ask yourself is, and then what? And we tend to do that around Berkshire, and so the stock going up is not an end of itself, because the next question is and then what? And to the extent that the stock goes up because the intrinsic value goes up, everyone is getting their fair share of the pie as they go along. To the extent it exceeds that in some way, the selling shareholder gets a benefit, but the entering shareholder is at a disadvantage. And we really like the idea of the price tracking intrinsic value over time, and we think that by having the right kind of shareholders and by communicating with them properly and following the right kind of policies, that we can come as close to that as is attainable in a world where markets essentially are fairly volatile. And so far, I think it's worked out pretty well that way. But the intention is to, and the goal is to keep it that way. One thing to remember, in the end, the owners of businesses in aggregate cannot come out any way better than the businesses come out. I mean, the businesses are and not just our business, I'm talking about all American business. The profitability of American business determines the profitability of what the owners of American business have. And you can forget all about the little ticker symbols and everything else. The owners suffer to the extent that they have some extra costs imposed in brokerage commissions, fees, all kinds of things. That diminishes the return from the business. But no one has figured out yet how to perpetually have owners do better than their businesses. And our idea is to have them do it as they go along in proportion to the gain that occurs during their tenure as a shareholder. And that isn't easy to do, and it's not attained perfectly, but that's the goal as we go along. Zone 3.
Morris Spence, and I have a serious question and then a less serious question. First, the less serious. You said that you and Charlie had lost between you 100 pounds. I was curious who had lost more.
No, I said the board had lost 100 pounds. I have some members of the board who would take umbrage at the fact that they weren't included in that total.
Okay. Who lost?
Charlie and we're pretty close at the moment, aren't we? Modesty.
I must say you're both looking very good anyway. I was wondering who lost the most and what your diet secrets were. And then the more serious question was about float. You touched on this a little bit earlier, but you've often said that your insurance business is probably the most important business that you own. On page 12 of the annual report, you said, "We have benefited greatly to a degree that has not been generally understood because our liabilities have cost us very little." I was wondering if you could describe this a little bit better so we can understand it.
Yeah, Charlie and I have lost about the same amount, at about 20 pounds each. The insurance business provides us with float, and float is money that we hold that doesn't belong to us. It's like a bank having deposits. A bank has deposits. The money doesn't belong to it, but it holds the money. Now, when a bank holds deposits on everything except demand deposits, there's an explicit cost and interest rate attached to it. And then there are the costs of running the system and gathering the money, which is also must be attributed both to demand and time deposits. So there's a cost to getting what they would call deposits and we could call float. In the insurance business, a similar phenomenon takes place in that policyholders give us their money at the start of the policy period, and therefore we get the money paid in advance for the product. And secondly, it takes time to settle losses, particularly in the liability area. If you bang up a fender on your car, it's it's going to get settled very quickly. But if there's a complicated injury or something, it may take some years to settle. And during that period, we hold the money. So we have, in effect, something that is tantamount to the deposits of a bank, but whereas the deposits of a bank, it's quite easy to calculate the approximate costs. In the case of the float that the insurance company has, you don't really know what the cost of that float is until all your policies and losses, your policies have expired and your losses have all been settled. Well, that's forever in some cases. So you're only making an estimate as you go along of what that float is costing. To date, with Berkshire, in the 29 years we've been in the business, it appears, never certain, because you don't know for sure what's going to happen, but it appears that our float has not cost us anything on average. It's been years when we've had an underwriting loss when there's a cost. There's been years when we had an underwriting profit, and so we had a reverse cost. So we have obtained that float on very advantageous terms over the years. Far more, fully as important as that. It's important to get it at a low cost, in our case, no cost. But the other important thing is that we've grown it dramatically. And so we've gotten more and more money without having any cost attached to it. And if we still had our 17 million, I guess, of float that we had in 1967, and it was no cost, it would be very nice, but 17 million of free money is worth something, but it's not worth a ton. Having 7 billion, if we can achieve that as free money, it's worth a lot of money. And that growth has not probably generally been appreciated fully in connection with Berkshire, nor has the interplay of how having zero cost money in terms of affecting our gain in value over time. People have always looked at our asset side, but they haven't paid as much attention to the liability side. Charlie and I pay a lot of attention to that, and I mean it's not entirely an accident that the business has developed in this manner, and we have intentions of trying to make it to continue to develop in this manner and in that manner in the future. But we've got competitors out there too. Float per se is not a blessing. We can show you many insurance companies that thought it was wonderful to generate float, and they have lost so much money in underwriting that they'd be better off if they never heard of the insurance business. But the job is to get it in increasing quantities, but above all, get it cheap. And that's what we work at. And you do that in the business through having some kind of competitive advantages. You won't do it just by having an ordinary insurance company. The ordinary insurance company is not a good business. We have it in certain respects because of our attitude toward the business. We have it because of our financial strength gives us certain competitive advantages. And we have it in the case of Geico because of a very low-cost operation. And it's up to us to try and figure out ways to maximize each one of those competitive advantages over time. We've built those advantages. I mean, in 1967, we were not looked at that way in the insurance business. We've built a position of competitive strengths, and in the case of Geico, they had it without us, but we have bought into it over time. It's a very important asset, and you ought to pay a lot of attention over the years as to what is happening with that asset as to both growth and costs, and that will aid you in calculating intrinsic value. Charlie?
Nothing to add.
Okay.